Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. The Bank of Canada left its key policy rate unchanged at 2.25%, revised upward the growth forecast for this year to 1.2% and 1.6% in 2027. Governor Tiff Macklem says holding rates steady is the right move, but noted that if surging energy prices stay higher for longer, rate hikes may be needed. Macklem highlighted that Canada isn't facing a regular kind of economic uncertainty and says the bank will need to be nimble due to current geopolitical events.
If there's significant new trade restrictions on Canada, that could have a material impact on the Canadian economy. We may need to cut to support growth. If oil prices go up, and particularly if they stay up, the risk that inflation becomes more persistent goes up, and there may need to be increases in the policy rate. And as we indicated, probably more than one, consecutive increases.
Shares of Canadian National Railway are seeing some pressure after missing profit and revenue estimates in its latest quarter, off about 5.65% right now. CN also saw revenue decline across its metals and minerals, forest products, and automotive segments due to pressure from U.S. policies. The rail company adds that ongoing uncertainty in the macro environment has been affecting performance. CGI is the worst performing stock on the TSX today. It's off nearly 15%. Revenue for the IT and business consulting firm came in below estimates in its latest quarter, while profit was in line with expectations. The company's bookings also fell by about $150 million. On the upside, CGI did see revenue grow annually on favorable foreign exchange and credited its performance to its AI-first strategy and clients' continued investment. And a quick look at the markets right now. The TSX, another off day. It's down by about 0.88%, being dragged down by industrials, materials, tech as well. Energy on the plus side, up about 1.3%. South of the border, it is, they're all in the red now and solidly into the red. The S&P 500 off by 0.3, Dow Jones by 0.65, and the NASDAQ off by 0.43. Well, the Bank of Canada has decided to hold its key interest rate at 2.25%, a move my next guest describes as maintaining a balanced yet fragile macro environment. For more on the movement of the markets and economic outlook is Jillian Stovall-Rivers, Senior Wealth Advisor at CI Asante Wealth Management. Jillian, thanks very much for joining us.
Thanks for having me.
It is a balance right now, isn't it? What a tightrope.
It is, absolutely. It's a tension point. Inflation is close to target, but energy prices are rising, and that seems to be what Mr. Macklem signaled today as the main concern. Growth, maybe not so much, although it is slow. And so a hold says that the bank is equally concerned about reigniting inflation like we saw in 2022 and wanting to make sure that we still have a couple of bullets in the chamber, if you will, to be able to solve that if inflation does become a problem. So if stimulus is needed, there's still a little bit left to ease on rates, and that's a really good thing, but it is a tightrope indeed.
And the two big things obviously are oil, Iran, what's happening there, and CUSMA and the negotiations for it. With oil, is this a good thing long-term, bad thing long-term? What do we want to do with it?
I honestly think it's a double-edged sword. It's potentially a great story for Canada's resource sector, but at the same time, it's a short-term additional tax on consumers. We're already in this country. I think it's 180% of household debt or household income, is the current debt carriage ratio for the Canadian. And that means we're in a very delicate place as far as additional pressures on pricing. And so that inflation concern as it relates to oil remains a very real one, but there is still a sort of a longer term play for Canada when it comes to the power of that sector for us.
Because it could turn into a huge thing.
It could.
If this drags on, people could keep turning to Canada and looking at it, as a reliable source.
The Canada Sovereign Fund, which was talked about yesterday, obviously that's an incredibly powerful way to monetize our assets, our national assets, in a way that can pay dividends for generations to come if it's done well. And so there would have to be some other levers to give the Canadian consumer and Canadian household a little bit more relief at home if that were to be something positive for Canada.
And then we can throw in CUSMA, which, I mean, the talks are going on. If it's resolved quickly, what do you see the bank doing? What do you think? I guess if CUSMA is renewed, I think is what a lot of Canadians are probably hoping for.
Yes, well, that remains a negotiation that is very, very close to home. It's also a reason why Canada hasn't been as involved in things like OPEC. And as a result of today's other announcement about the UAE leaving OPEC, I think this kind of opens the doors for interesting negotiations across the globe, not just across North America, as it relates to tariffs, as it relates to trade, and as it relates to the power that energy sector really plays in a lot of those negotiations. Where do
you see Canada fitting in there with those potential? There's lots of potential.
Your guess is as good as mine.
Oh, I'm not guessing. I'm not here to guess. You're the experts. But it is, the OPEC one is an interesting play. I mean, do you see it existing, and then can Canada benefit from the UAE pulling out?
I think it's such an interesting development, and it's also interesting that it happened on the day where I get to come and talk about it, because I think it opens up the idea of that cartel having as much power over the supply and over, therefore, the price of oil, which we've seen go through the roof. And if that's the thing that is potentially holding consumers back, then maybe that's another lever that can be used internationally in peaceful negotiations in order to make sure that we continue on a positive growth trend globally and not at the risk of hurting the consumer.
Could you see something like OPEC coming up in North and South America? With Canada, Venezuela, the U.S., Guyana?
Yes, and there are, in fact, several participants in OPEC from South America. We have never participated in it because of our relationship with the U.S., but a lot of those countries that are in OPEC are ones that we could have stronger negotiation and maybe even relations with in the future.
Okay, so what are we doing then with all this? What do you think where does the bank go over the next year with this, with everything that's... we've heard rate hikes, we've heard rate cuts.
Yes.
Possibly one cut, possibly two hikes, possibly three hikes.
Yes.
What do you think?
Well, I think that growth signal, the forecast that were given today, were really powerful indicators on what it is that Mr. Macklem's looking for in order to be able to guide future rate hikes or future rate cuts. And if we can navigate those growth trajectories in a positive way, then maybe we can not have any more air come out of the housing sector and not have any more concerns with increases in rates that cause it to be very uncomfortable for businesses to reinvest in themselves in Canada. It would be great to hit those growth trajectories, but it's going to be a very delicate balance because energy plays such a huge role in the profitability of a lot of these sectors.
Okay, now I'm just going to throw in earnings. And up until, the Canadian ones, it feels like they've been a little bit hit and miss. Down south of the border, it seems like they've been mostly pretty good.
Yes, and I think it's also an interesting day to be talking about earnings. I can't speak specifically to any stocks in particular, but when you look at the cross-section of, you've got a perfect snapshot of where we are structurally right now. You've got really AI-driven growth from companies like Microsoft and Alphabet, but then you've got some sensitivity on CN Rail and West Fraser, but then there's a lot of good real economy signals coming out of energy and materials and REITs. So what this tells me, and I love this, to be honest with you, is that it's not a one-speed market or a one-speed economy, and it's fragmented. And investors need to be diversified across all those drivers, because I personally like that a lot better than all of these different sectors being tied to one wave. We've had that kind of momentum before.
With the Mag 7 and tech.
Exactly. Right? And that's fun for a period until it's not fun anymore. And so I really like the diversification and fragmentation right now. So
you feel it's a healthy balance, is returning to a healthy balance?
I think it is. And I think what it becomes is an environment where you're not all in or all out on anything, but instead you're constantly adjusting at the margins. Because what I see about this environment right now is near term, we have these inflationary pressures. But if you think of that as one eye looking near term and the other eye looking long term, AI can actually have a pretty deflationary inflationary impact on our markets and our economies in the long term. So what I like about the fragmentation is we have places where we can operate these levers in order to remain defensive when it comes to certain moments of inflation and growth. And we can be a little bit more aggressive with some of those Mag 7 companies over the long run.
But it sounds like you really got to do your homework.
You do have to do your homework.
All right, Jillian, we have to wrap it up there, but thank you very much for joining us today. I appreciate
Thanks
you
so
coming
much for
in.
having me.
Thank you. And that was Jillian Stovall-Rivers, Senior Wealth Advisor at CI Asante Wealth Management. Up next, Bill Ackman's long-anticipated IPO raises billions, but did favoring retail investors over Wall Street come at a cost? Find out after the break. Hedge fund billionaire Bill Ackman finally takes Pershing Square public, raising $5 billion in an IPO that was oversubscribed, but landed at the low end of expectations. However, institutions were deliberately cut back to give retail investors a bigger slice. For more on this story, let's bring in Bloomberg News reporter Anthony Hughes. Anthony, thanks very much for joining us.
Hi.
All right, did his move work, or is it going to work? Where do we stand with it right now, his decision to cut back on institutional investors?
Well, it's momentarily the two entities that Mr. Ackman's bringing to market today, which is Pershing Square USA, which is a closed-end fund, and Pershing Square Inc., which is his asset management firm, which runs the closed-end fund. They're both going public today, and the indications are that they're both going to trade collectively in a way in which investors are probably going to be a little bit down on their money. But Mr. Ackman's saying this is sort of the uneven trading you can see in the first few days, and over the long term he'll be able to deliver for investors. But it's an unusual situation to have two entities listing like this on the same day.
Is there a benefit to it, or do you think it's going to end up hurting?
Well, I think Mr. Ackman's saying that he's attracted long-term investors to his closed-end fund, and closed-end funds usually trade at a discount to NAV, so it's not surprising that it will likely trade at a discount here today, and but the discount is quite significant, and I think there'll be some disappointment that when it's combined with the free share that investors were given in the in asset management company, which was a incentive for them to participate in this offering, it'll turn out to be net not a good investment, at least not a very good investment short term at least.
And with the retail participation, have we seen any numbers, or have we heard reaction to it from them, from that side? Yes.
Well, these closed-end funds are really more oriented towards retail investors. The difference here was that Mr. Ackman had lined up $2.8 billion of commitments out of the $5 billion from cornerstone institutional investors. But when he tried to do this a few years ago, he really went for pretty much a straight closed-end fund offering. But by offering this inducement of a bonus share in his asset management company, it made it much more interesting for institutional investors. And obviously, a man who's a big hitter on Wall Street like Bill Ackman was able to find people to provide him with a significant amount of money, at least up front. But I think like all IPOs, the first day's trading isn't always indicative of how it will trade long term. But in this case, closed-end funds have a pretty mixed track record in terms of, well, at least they tend to trade at a discount to NAV, and that means that they don't work very well as IPOs, in short.
All right, and what can we expect next over the next 6 to 12 months?
Yeah, well, today on Bloomberg TV, Mr. Ackman said that he'll be looking to invest the proceeds of the IPO pretty much within weeks, and he'll do that by buying primarily shares in companies that his other funds already have large investments in. And if you look at his portfolio of the other funds he likes to have concentrated positions in some pretty large companies, and he has basically a dozen or so companies that he really loves, and those companies at the moment in these other funds include names like Brookfield, Uber, 3 of the Mag 7, and Fannie Freddie famously, and companies like Restaurant Brands. And so I think you can expect him to buy more of those stocks, and at least in the situations where these are large and liquid stocks, he'll be hoping that won't move the market.
All right, Anthony, thank you for that update. We appreciate it.
No worries.
Bloomberg News reporter Anthony Hughes. Coming up, Starbucks delivering a strong quarterly beat, but the key question remains unanswered. We will talk to one analyst who has a sell rating on the stock. Stay tuned. Over the past year, the new Starbucks CEO has poured millions of dollars into turning around the coffee chain. The results showing up in a strong quarterly earnings beat. But will the turnaround last? And can margins continue to expand? Let's find out from Jacob Aiken-Phillips, Director of Consumer Research at Melius Research. Jacob, thanks very much for joining us.
Yeah, thanks for having me.
Okay, let's get this out of the way. They're up in the trading right now, but you still have a sell rating. What's your reasoning behind that?
Yeah, I mean, so to be clear, management definitely deserves some credit here. They've turned around the store operationally. They've invested a lot back in labor, and they really drove a big traffic beat versus what the street was expecting. Although I will say that last year, they had a negative 4% traffic. So it's all an easy comp, but it's definitely a signal that the turnaround is happening. That said, U.S. margins did go down, and there will be continued pressure on U.S. margins. The consolidated operating margin increase was partially due to the deconsolidation of the China entity. And so I just need to see sustained traffic recovery, because to get to their long-term algo or to beat it, they're going to have to comp over this next year and the year after that and the year after that.
Where do you see the pressure on the margins in the U.S. coming from?
It was like probably mainly coffee. Well, labor was a big part, and then coffee inflation, where although spot prices have come down a bit, the way Starbucks hedges, they're seeing the most pressure in the first half of this year.
And let's talk a little bit. What have they done? You commented on it, but what were some of the biggest things that you see that you actually like about it?
Yeah, I mean, the back to Starbucks plan, the putting labor back in stores, getting service times down, really adding a queuing system so that mobile orders happen at the right time. And so you're not waiting for people to make mobile orders while you're actually in the store waiting. All the things like that, although it does weigh on the operating margin, is really beneficial to the store from an operation standpoint, and the guests are seeing it. I'm more likely to go back if I'm in and out in 4 minutes and I have a really good experience with the barista.
Okay, so that's all right. So that's one of the big things. And I mean, international markets, they were all returning to positive comparable store sales for the first time in 9 quarters. That's got to be a positive for them.
Oh, definitely. I mean, the international story has never been, in my view, like I never questioned it. The international unit growth and then eventually getting back to positive transaction growth and sustaining that is something that I could easily see. I've been more focused on the U.S., North America, and particularly the U.S. business, because that's the foundation. And if the brand equity declines there, then you would see impact more broadly across the globe.
And now you mentioned with China, go a little deeper with China. Where's Starbucks heading with that? What's your concerns?
Yeah, I mean, there's a lot of competition in China. So they found a good operator, good local operator, which I think they needed, because there are some local intricacies that is in China that's not present in the US. It's a huge delivery market. There's like lots of local competition. Walk-in is a big competitor, and they're very convenience focused over there. But with the new local operator, I can see them getting back to unit growth. It's just going to take over a multiple year horizon, which is fine because they monetized it.
And as we look forward, the guidance, what was there anything you felt was missing, or is there anything you would like to have seen stronger on top of what you mentioned already?
No, I mean, I think for the year, the guidance is probably maybe, I wouldn't say conservative, but like probably on point. But they did not withhold, but they maintained the 2028 outlook, the $4 EPS. And I think that the general consensus now is that that's probably like conservative. But like you asked why I'm sell on it. If they even beat the $4 EPS 2028, let's say they get to 5. At the current price, you have to put 25 to 30 XP multiple on a 2-year out number just to justify that. And I think there are better opportunities across my space and across the broader landscape. at a much more compelling multiple.
What are some of the better options you think?
So Yum just reported this morning, Taco Bell's outperforming the entire QSR market, 8% comp. They have an excellent technology system, Bite by Yum, that is layering on AI, and it works across all their brands, and they're just expanding greatly. I also really like Dutch Bros. It's a coffee competitor to Starbucks, but it's more on the convenience side, and they actually already have the energy lineup. I think like half or even more than half of their sales are energy drinks and not coffee.
Could you see any M&As in that sector at all with that?
M&As in restaurant overall?
Starbucks looking at a couple of those competitors that you just mentioned?
I think that Dutch Bros, it would have to be a very high price and for Dutch Bros to be willing to sell, so I don't see that happening. But also, it's just a cultural clash. Well, not a clash, but like
different.
Starbucks is all about back to the third place, making a nice coffee house. Dutch Bros is all about convenience, drive through.
All right, Jacob, thanks very much for joining us today. We appreciate it.
Yeah, thanks for having me.
Jacob Aiken-Phillips is Director of Consumer Research at Melius Research. Up next, the Iran war and trade uncertainty seem to be the biggest contributors to the Bank of Canada's rate policy decision. We'll discuss details right after the break. Aecon Group is one of the best performing stocks on the TSX today. That's after the engineering and construction company beat expectations for first quarter revenue, which grew 18% compared to the year before. The Toronto-based firm also posted a record backlog of almost $11 billion. Aecon says it expects 2026 revenue to rise further, driven by growth in new markets, recurring revenue programs, and strong opportunities in power generation and defense. Health Canada has approved its first generic version of Ozempic. This paves the way for cheaper access to popular diabetes and weight loss drugs. The federal department says it is currently reviewing 8 other submissions for generic semaglutide by different companies. It is the main ingredient in Ozempic. Launch preparations are underway, but a time frame has not been provided. Shares of Visa are getting a boost. The credit card giant topped profit and revenue estimates in its most recent quarter and says resilient consumer spending contributed to the upbeat results. The outperformance was also driven by strength in payments and value-added services. Analysts view the results as a positive for Visa and note that payment volumes are showing signs of stability. And a quick look at the markets. Another down day for the TSX. And it is being driven by the materials sector. As one of them is off right now, and tech as well. Industrials having down days. On the plus side, it's the energy index helping to minimize that. South of the border, U.S. markets all in the red as well, awaiting the Fed announcement in about a half hour from now. We'll see what happens with that. But they're all in the red right now. Well, the Bank of Canada held interest rates steady at 2.25% today. The central bank saying any further adjustments will likely be small. Here to talk more about the decision is Ali Jaffrey, Chief Economist at KPMG Canada. Ali, thank you very much for joining us.
Pleasure to be here, Roger.
All right. No real surprise. What caught your eye today? We pretty much everybody knew it was going to stay. They were going to stand pat. But what caught your eye about what they said or they didn't say?
I was impressed with how open the governor was to talk about the range of circumstances that the bank is confronted with and what they would do. So there was a bit of extra guidance that the governor provided this time around, talking about what they would do in the event of high oil price scenarios and talking about the magnitude of changes. That is new. And I think the purpose of that was to maximize optionality for the Bank of Canada while minimizing their near-term commitment.
Excuse me. So they really are. They really are walking a fine line right now, aren't they?
Absolutely, because there's two different shocks going on in the Canadian economy. We have the near-term pressure from oil prices that is obviously going to push inflation up and move inflation above its target, potentially materially in the near term. But demand in the economy is weak. Underlying inflation core measures are printing at 2%. The labor market is soft with a jobless rate uncomfortably close to 7%. And the output gap, the broad measure of slack that the Bank of Canada focuses on, is at minus 1%. So they have to balance these two challenges of an oil price shock and an economy weighed down by trade tensions and shifting immigration. And I think they did a good job today by laying out the various things that they're looking at and that they're willing to be nimble and react. But ultimately, they feel comfortable where policy is today. And that's where I expect them to remain.
And they were doing some of their basing on oil at 75 a barrel for 2020. I believe it was 2027. Is that
2027?
27. Yeah. Is that a reasonable base for that?
You know, Roger, it's very difficult to have a forecast for oil prices, and I won't criticize the Bank of Canada for that. But their approach is pretty sensible. They're using the oil futures curve, and that has WTI getting to about 70 by the middle of 2027 and Brent at 75. And I think that's a reasonable base case scenario. But of course, it all depends on the negotiations between the U.S. and Iran and the opening of the Strait of Hormuz. But for a base case scenario, I think that's sensible.
And I was interested by one of your notes that Canada has been the least hardest hit, I guess, by the oil prices.
That's right. I think Canada comes into this shock on better footing than many of its advanced economy peers. So also, Canada's a net energy exporter, so obviously it will benefit over time if prices remain. But this squeeze on purchasing power, which you see in the chart right now, and it shows that Canadians are facing less of an energy price increase relative to other countries because we're seeing an offset from natural gas prices declining. And beyond just the lower squeeze on purchasing power, we entered into this period of having seen inflation at target for a year and a half, something the governor referenced several times in his press conference. And monetary policy is set probably at the right temperature in a neutral stance in the bank's neutral zone, whereas other advanced economies are either above or in a different position, and they may have to move more quickly. I think the bank is positioned well to wait and see.
Now, I was just curious because the U.S. is an exporter as well. Why are they so much higher than us on the impact of the prices?
Well, we're benefiting from a glut in natural gas from mild winters in some part of the country. So that's the main force bringing energy prices down. So that takes gasoline, fuel oil, and natural gas all together. And so we're benefiting from a supply glut in natural gas, whereas other countries are less fortunate.
All right, and the other aspect, the other thing we need to talk about, CUSMA negotiations. What kind of a factor is that? The tariff pressure with the bank and with the economy?
It's very important, and the governor referenced that multiple times. It's a big feature of the NPR. That's a long simmering challenge, and we won't have clear light at the end of the tunnel until we see what happens in the negotiations. So they have their eye on that. And that has been a significant shock to the Canadian economy. We estimate that it's taken about 1% out of GDP. It's weighed on the labor market. It's depressed prices. I think it hasn't raised them as was feared by the Bank of Canada. But when they want to see where they ultimately go in monetary policy, they'll have to know how those trade talks evolve. Is there a ratcheting up of trade tensions? Or can we get to an agreement where that Canadian businesses have more certainty in their engagement with the United States?
And in this, can we even predict or guess at what we might see, either rate hikes or rate cuts with the bank towards the end of the year, maybe?
I think our base case is in the event of that the Middle East conflict is short-lived, that's resolved in the next few weeks, and obviously that's a big challenge. I expect that bank will stay where it is right now. It's a right balance to manage the weakness in the economy, to allow the economy to heal, to adjust, and also ward off supply shocks like the oil price shock we're seeing now. And anything else we might see beyond that. So I think they're in the right place, and I expect that they'll hold for the remainder of the year, assuming that the conflict remains short-lived.
All right, just one last question. Of course, south of the border, the Fed as well today. What can we expect, and what's next for it?
I think a similar discussion will happen in the Fed, that Chair Powell is going to be on hold, and I would expect there to be more consensus in the committee around that. There's a little bit of a difference with Canada, where the Canadian economy is weak. the U.S. economy is a bit stronger and inflation is strong. It's been underlying inflation in the U.S. economy has been around 3%, whereas in Canada it's been 2%. So the Fed will want to wait and see how the shock evolves, of course, as are other central banks. But there'll be more pressure to hold and hike potentially than there will be to remain at a balanced position, because the U.S. has had underlying inflation at 3% for quite a while, and it's now going at 6 years above target. So I think that will be the focus of on the econ side, but I'm sure there'll be a lot of questions also about the chair's role in the committee and whether he remains.
All right, Ali, thank you very much for joining us today. We appreciate it.
My pleasure.
Ali Jaffrey is the chief economist at KPMG Canada. When we come back, we'll look at what the new federal economic update means for affordability and for Canada's broader economic outlook. That's after this. The federal government released its spring economic update, projecting to spend $37.5 billion over the next 6 years, aimed at national security and affordability measures for the average Canadian. For more on what this means for the economy more broadly, we sat down with Travis Shaw, Senior Vice President and Sector Lead of Global Sovereign Ratings at Morningstar.
From a credit ratings perspective, we continue to rate Canada at AAA with a stable trend, and we don't see this spring economic update as materially altering that outlook. If anything, it's neutral to mildly positive in terms of seeing a little bit of improvement on the fiscal outlook, and debt continues to trend downward. So, not without some downside risks and obvious headwinds, but nevertheless, we continue to see the federal government as managing the finances relatively well, given the circumstances.
What are some of the concerns or risks?
I think first and foremost, I think we continue to watch the evolution of trade relationships, particularly with the United States, with the upcoming renewal of the CUSMA agreement, and obviously that potentially has big implications for the Canadian economy. So we're keenly watching that to see how that evolves, and then the ongoing conflict in the Middle East and the impact that's had on oil prices globally, and certainly what that means for Canadian exporters and Canadian consumers. Right now, in terms of the fiscal update, that's having a bit of a positive impact in terms of higher nominal GDP, which is leading to expectations for higher federal revenues. And that's really allowed the federal government to go ahead with some of these affordability measures in the latest update, while still keeping their overall targets on track.
And what are your thoughts on the deficit lower? Could they have lowered it even more, or is it in a comfortable range for you?
I'd say yes to both of those questions. It's in a comfortable range for us. If we look at we look at the current deficit around 2% of GDP and expected to decline gradually thereafter. Certainly we believe is manageable for the time being. And provide some flexibility to respond to further shocks should they arise. That being said, we would certainly welcome somewhat smaller deficits and a faster decline in the debt burden. But we understand the circumstances in terms of the broader geopolitical context in which they're operating, and I think important to note too that yes, there's certainly increased spending. But I think in a way it is measured and targeted at affordability measures, some of them even temporary in terms of the removal of temporary pause in the federal fuel tax. So they're trying, I think in some ways trying to respond to the circumstances with what's expected to be, a temporary shock in energy prices with temporary relief in some related measures. So we see it overall as being relatively measured. And
of those relief measures, which ones do you like? Which ones maybe that you would have preferred not to see?
We're not really in a position to provide advice, or policy direction. We try to stay away from that. But overall, I mean, if we look at it in the context of the overall fiscal plan, the deficit for the year just ending this past March is looking to be, somewhat better. I wouldn't be surprised when the final accounts are tallied later in the year if we see even further improvement on those numbers in terms of a smaller deficit potentially. And then for the current year, it's really on track with what was projected last November with the Liberal government's initial budget then.
Okay. And going back, cutting the deficit and increased income, a lot of that's coming from oil. Is that a concern if oil prices drop again and that money evaporates?
No, I think you've got these competing forces at play. So you've got higher oil prices boosting revenues, but over the medium to longer term, should those persist, that has a negative impact on growth. So I think certainly Canadian government and Canadians, Canadian public more broadly, would welcome a moderation in energy prices, and that that would be more favorable for the medium-term growth outlook. So all in all, I think not a concern if we do see some moderation. I think that's the consensus forecast at this point. Some would argue that the figures in the federal spring economic update are perhaps a bit conservative and maybe using a somewhat lower oil price assumption that may prove to be. It's really anyone's guess at this point. Obviously, highly volatile. And a lot of uncertainty, but we'll continue to watch closely how this unfolds.
Yeah, definitely a lot of uncertainty, and I guess the big one, of course, the other big one, it's kind of taken back, it's gone back burner, but the U.S., the tariffs, CUSMA negotiations, how is that all playing in?
Yeah, I think in terms of the fiscal update that we just received, just got yesterday, it's certainly weighing on the outlook, and that uncertainty is factored into the economic outlook. But in terms of assumptions, the federal government's assumed really the status quo in terms of the existing sectoral tariffs on steel, autos, forestry, and aluminum, that those remain in place. But to the extent that we see any favorable progress on that, should negotiations progress, there could potentially there's risks both to the upside and downside in terms of how those negotiations unfold. Ultimately, I think the timing for a renewed agreement, we're starting to get up against a deadline in that, if we don't see those negotiations, gain some traction over the coming weeks and month or two, it's likely becomes a bit more challenging from the U.S. just given their upcoming fall midterm elections. So maybe a status quo for a period of time now.
That was Travis Shaw, Senior Vice President and Sector Lead of Global Sovereign Ratings at Morningstar. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Joining us now for some movers south of the border is Bloomberg equities reporter Matthew Griffin. Matthew, thanks as always for joining us, sir.
Roger, thanks for having me as always.
All right, first up, OI glass. It's half empty today, isn't it?
Yes, or maybe more than half empty. This stock plunging today. It is the latest company to be hit after flagging the impacts of the war in Iran. In this case, the maker of glass bottles said that higher energy prices are adding to its expenses. They cut their full-year earnings per share outlook to $1 to $1.50 US. They previously saw $1.65 to $1.90. And there was also some weakness in the first quarter, especially in Europe. Now, this is really the latest company that we've seen this happen to. You've had reactions negatively for example, Southwest Airlines, Honeywell in recent weeks. You saw Booking Holdings this morning reporting some weakness due to the war in the travel sector. So it kind of raises the questions for investors, and it's something that I will be looking at of which company is next.
All right, and I'm just curious, I don't know if you can answer this. I'm just looking at their Europe operating profit. It was zero versus 68 million year over year.
Yes, so that's a place they saw some demand weakness in Europe. I don't believe they got super granular on the reasons there, although I do know sort of across the board what they call an energy reset. So this rise in energy prices did hit their results in the first quarter. It sounds though like in Europe there were some other things going on as well, maybe just generally weak consumer demand.
Okay, and Robinhood taking a hit as well in the markets right now.
Yes, so Robinhood, another name with a double-digit sell-off, down as much as 15% earlier. That's their worst day since last spring's tariff panic. The financial technology company reported revenue in their most recent quarter that was a little below what analysts expected. They also raised their guidance for adjusted expenses this year. They say that these Trump accounts, so accounts seeded with federal money for newborn babies in the U.S., that's going to require a $100 million investment, although they expect them to be profitable in the long run. And you also saw a continuation of just some recurring issues for this company. For example, the weakness in the crypto markets we've seen recently.
And that was one of the biggest things that hit them. Any other, what were the other weaknesses?
I think it really was crypto and the higher expenses that have gotten a lot of the attention. That being said, analysts also pointed to some weakness in the profit they're capturing on options trading. Of course, this company rose to fame during the meme stock craze in 2021. A lot of people used options to trade there, so not the kind of headline you want to see as an investor.
All right, and last one, Seagate. It's going the other way.
Yes, so giving you a gainer for once, Roger. I feel like we've talked about a lot of sell-offs lately. Seagate having a little bit of a pop today. The memory and storage company gave results that the research shop Vital Knowledge calls blowout. Their adjusted earnings per share were $4.10. Analysts looking for just $3.50. They also beat on revenue, beat on an EPS outlook for the current quarter, beat on a revenue outlook. I mean, just green across the board. The latest strength we've seen for these memory and storage companies, their products in strong demand from data centers. You need to store and access a lot of data to train and run AI models. The rally just keeps going. This company, this stock was up 220% almost last year and has more than doubled again this year.
That's not a bad little run. All right, Matthew, thank you as always, sir, for joining us.
Roger, thanks for having me.
That was Bloomberg's Matthew Griffin. Well, planning for your child's future has never been more complicated. In the past, it meant setting money aside for an RESP and watching it grow. But a new survey says many new parents aren't in a position to do that. And many are also relying on their parents for help. CTV's Heather Wright has more.
Isabel. With 3 kids in university at the same time, Brad Nussbaum knows just how expensive post-secondary tuition can be.
It was sort of like childcare, right? Having 3 kids in childcare at the same time, it's expensive. School's expensive.
Brad and his wife made a deal with their kids. They'd pay for tuition, the kids pay for living expenses. Registered education savings plans help cover most, and they got creative to take care of the rest.
There's a lot of scholarships that don't go claim. So we had the kids apply for every scholarship that we could find.
But as post-secondary tuition rises, more families say they might not be able to fully pay for their child's post-secondary education. According to a survey from Embark and Angus Reid, just 33% of parents say they can cover their kids' tuition. 27% say they won't be able to, while 26% expect it will be financially difficult.
Despite the large number of new parents today are financially planning and budgeting for the future of their children, there's not a lot of confidence that they can afford it.
In its early parent readiness report, Embark, an education savings and planning company, says there is significant concern among new and expectant parents when it comes to the cost of raising children. More than half say they are only somewhat financially prepared, while more than 1 in 3 say they've received financial help from family members. The advice from both financial planners and parents like Brad is to plan early to have as much time to save as possible.
We did a lot of things for our kids to get them to where they are.
With tuition, rent, and other living expenses, post-secondary education in Canada can exceed $30,000 a year, a number that keeps rising. Heather Wright, CTV News, Burlington, Ontario.
All right, let's take a quick look at the markets on Wall Street and Bay Street before we wrap things up. And we'll start with the American markets right now as they await the Fed coming up ever so shortly in a few minutes from now. And you can see the S&P 500 off by 0.18, Dow Jones by 0.65, NASDAQ by 0.22. So another red day, but heading up to Toronto for the TSX. And it's in a similar situation. It's off by about 0.7. And when you look, the big ones taking the hit, materials, industrials, and tech, all off by around 2%. Energy kind of driving the other way. A couple of stocks we want to look at quickly. CGI, their shares are sliding, and they're down. What are they down? Now, 11.5%. Second quarter results missed expectations, and that's exacerbating already weak sentiment around the software stocks. So it's down. It's Montreal-based IT and consulting firm. It says the quarter was hampered by slower client decision-making in several key markets. And another one heading down today is CN Rail, and it's off by about 5.6%. Trade turmoil hurting it. Stock drops the most now since 2021. Shares are slumping. Revenue came in below expectations. And that wraps up this edition of Trading Day. Thank you very much for joining us. We'll see you back here tomorrow.